Welcome to ForexTV.com. Today's Wednesday, September 24th. I'm Remy Hookie for New York Forex Market Buzz. The U.S. dollar is trading at intraday highs against the euro and pound and is holding on to gains against the yen. Now let's take a quick look at the latest headlines from the CEP News Desk. U.S. lawmakers heard testimony by Federal Reserve Chairman Ben Bernanke and Treasury Secretary Paulson on plans to pass a $700 billion bailout plan. Members of Congress continue to weigh the price tag on the plan. The Senate Banking Committee remains skeptical about moving too quickly on the massive plan and that the proposal required careful discussion as well as consideration. Meanwhile, Warren Buffett announced late yesterday that he was buying a $5 billion stake in Goldman Sachs, the Wall Street firm that is transforming itself into a commercial bank. Buffett's Berkshire Hathaway will pick up $5 billion of Goldman's preferred stock. And overnight, the U.S. Federal Reserve announced that it had set up currency swap agreements with the Danish, Australian, Norwegian, and Swedish central banks worth up to $30 billion. The central banks join agreements already established with the ECB, BOE, BOJ, SNB, as well as the BOC, already worth a total of $247 billion. And earlier this morning, the National Association of Realtors reported that U.S. existing home sales fell 2.2% in August to an annualized pace of 4.91 million units, and total housing inventories fell to a 10.4-month supply in August, down from the downwardly revised 10.9-month overhang recorded in July. And the EIA reported that U.S. crude oil inventories dropped by 1.5 million barrels in the week ending September 19th. Crude oil futures advanced but came off highs above the $109 a barrel level. Also, gasoline supplies fell by 5.9 million barrels, greater than expected. And highlighting economic data from overnight, there was a larger than expected decline in German business confidence and falling retail sales in the UK. The business climate in Germany deteriorated more than expected, with the IFO Institute's Business Climate Index falling to 92.9 in September, following August's decline of 94.8. That is its lowest level in over 3 years. Joining me this afternoon to discuss the latest in FX is Greg Michalowski, Vice President of Research and Markets at FXDD. Good afternoon, Greg.
Good afternoon, Remy.
Thanks for joining me today.
It's my pleasure.
Well, Greg, as the markets continue to monitor developments on the second day of testimony by Bernanke and Paulson, the U.S. dollar is higher against the majors, but liquidity is thin, and we do continue to see range-bound trading. So given the magnitude of this bailout proposal and also opposition we're hearing from the lawmakers, first, if you could give us your take on the proposal and also the price tag, and as everyone waits on the sidelines, if you could tell us how your rate outlook for the Fed has shifted.
Okay, first of all, my opinion on the proposal is that it is needed. We're seeing a seizing in the banking and the financial sector, or the potential, certainly, of a big seizing in the financial sector, and that is not a way to grow an economy, to build an economy. So what the Fed and Treasury are proposing is to take this toxic paper off the bank's balance sheets, so it opens up lending and gets the economy going again. This is definitely something that is needed. We're seeing an increase in LIBOR rates. We're seeing commercial paper, demand for commercial paper slowing as redemptions in the money market funds come in, and all this are credit things that allow the engines of the economy to go. We haven't even talked about the effects on the consumer, but certainly they're going to be affected by higher rates, and for LIBOR rates, for instance, because LIBOR rates are used for equity loans, and they're used for other things, car loans and stuff like that are going to be affected as well. So all these things have a trickle-down effect that is going to have an effect on the economy, slow the economy, and it could cause really some dire financial problems. I don't want to say runs on banks, but it's certainly the house of cards could fall down, and this could actually happen. And that's the seriousness of the whole thing. And so Bernanke and Paulson are up there on Capitol Hill trying to get their ideas across, trying to convince Americans that this isn't just for Wall Street, this is for America. And that's what the consumer and the taxpayer have to understand. And hopefully in return, for the funds, $700 billion. Who knows if that's going to be all used or more is going to be needed or what? No one really knows, but it's just a large enough number, I think, to make it all possible. But maybe at the end of this, everything will stabilize. We'll get some some stabilization in the housing market, and the economy will do better. So what is it going to do for rates down the road? I think the longer, if there's a delay, if things don't pass in a expedient time period, the effects on the economy are going to be more negative, and as a result, this may lead to further Fed easings. I honestly don't think that they're going to necessarily do anything, that there's so much uncertainty out there, and 2%'s fine enough as it is now, and there are other rates that are more important that the Fed wants to see stabilized, like mortgage rates, for instance. We can't see them continue to go up or be pressured. They would like to see that when they take the toxic paper off the bank's balance sheets, that these rates sort of come down a little bit, and that this helps out the consumer and gets the economy going. So I think that rates overall from the Fed are kind of going to remain the same until we get a better idea of what the effects on the economy are going to be.
Well, Greg, adding to what you said earlier today, Bernanke did say that without credit markets working effectively, the economy cannot grow. And keeping that in mind as we await what unfolds, we will probably continue to see choppy range trading in the majors in the short term, but let's take a closer look at Eurodollar. Now, earlier, the IFO's German Business Climate Index came in weaker than expected, and fundamentally further slowdowns in the Germany economy are anticipated, and economists do speculate that the ECB may have to revise down its growth forecast. Now, the proposal that we're awaiting from the government will continue to remain in focus, but given your forecast, what should traders of Eurodollar keep in mind?
Right, exactly. We are seeing weakness out of the Eurozone, and it is prompting ideas that perhaps they're going to have to ease a little bit sooner than what their expectations are. And apparently the IFO also didn't take into consideration, some of the turmoil that's happened over the last few weeks. So the expectations of the next month might even be weaker. So with that said, we are seeing the euro a little bit under pressure. I mean, granted, it rallied strongly on Friday and Monday, and this from a technical perspective is nothing more than a consolidation. But having said that, there is good technical support, which may give you a clue as far as the direction goes for the euro. And there's a good floor in the euro at 146.34. We just went down there and checked the level again for I don't know, probably about the 8th or 9th time that on an hourly bar that the price has been down toward that level. And this will give traders a good idea as far as the direction and maybe even the fundamentals of what the market is thinking in regard to the euro versus the dollar. Now, so if it should break this level, 146.34, I would expect that a target level would be 145.55 in the short term. And then, depending upon if you can get through that level, it might even go further down. And so, the markets are very in a fluid situation right now. There's a lot going on in the U.S. There's a lot going on in the ECB as well as far as their economy. So the best way to trade the market or to look at the market, in my opinion, in that case, is to let the charts and the technical patterns tell you what to do and what not to do, I guess. And if you have a good level of support or a good floor, that's going to give you an idea. Well, I'm going to try to buy against this and go up. If it goes below it, I'm going to sell it. And that's a nice, easy way to have the market make your decision for you.
Well, Greg, now that we've covered Eurodollar, let's also take a look at the sterling. Now, the pair is also in a range in today's session, and we are seeing consolidation. But we just talked about Eurodollar, and Euro sterling has also, not surprisingly, been trading sideways. But also fundamentally and technically, how are you factoring in the latest developments and finding direction for the sterling?
Well, it's the same story, Remy. I have to be boring in that respect, and just like the the euro, there is a lot of fluidity to the economies both here and in the UK that are changing almost on a daily basis, and we've seen the sterling rally strongly again from Friday and Monday, and now it's in the consolidation phase, been going sideways. The one thing when this happens is that the markets are here to facilitate and trade, and when they get in these sideways patterns, like on the hourly chart, for instance, and stay in between a narrow support and resistance level, you know that eventually it's going to break out one way or the other to the downside or the upside. And once again, I'll reiterate that if you let the charts tell you what the fundamentals are going to do this time, then it makes the decision easier for you and takes the emotion out of it. So in that respect, there is a floor in the sterling at 184.81. Again, like the euro, we just went down to that level and tested it. Probably for the sixth or seventh time on an hourly chart. And on the upside, we have a topside ceiling at 186.39. So I would just use those levels as short-term support and resistance levels, and look for the breaks on one side or the other, and go with the breaks. And if it comes back in the trading range, then it didn't follow through. But if it continues on in the trend of the direction of the break, then you'll be a happy trader.
Okay, Greg. Well, now that we've established that the market as well as investors and traders are waiting for the smoke to clear, let's take a look at the yen. What's your strategy, not just for dollar-yen, but also for the yen crosses in the current environment?
Well, let's speak, first, I guess, on the yen crosses. They've been under pressure as people have been less, more risk averse, I guess, if you will. But they have had a correction as in the short term here, as a result, we're going to see some volatility in the dollar yen off of these crosses. And which way they go again is subject to is the stock market going up, is oil going up, is oil coming down. It's almost it's very hard to gauge on a day-to-day basis, and it's very much influenced by the quote-unquote risk aversion or risk. I'm willing to take on risk. So if you see the stock market go up 800 points, you're going to see sterling yen and euro yen and all the yen crosses kind of follow along with it. Having said that, looking at the dollar yen chart, one thing that sticks out in my mind, or when I look at the chart, is both the 100 and the 200-hour moving average are sort of going sideways and converge on each other. And the market over the last few days has remained within, the 100 and 200 moving averages stayed within the goalposts, if you will, of what is the ceiling and what is the floor. So I have the ceiling at 106.34, and I have the floor at 105.15 at the moment. The 200 and 100 hour moving averages, which are a good barometer of the direction of the market, are sitting right in the middle, about the 105.80 to 105.98 level. And so again, it becomes boring but simple. If it breaks out to the top side of 106.34, then I'm a net buyer. If it breaks below it at 105.15, I'm a net seller. And let the crosses kind of do their thing. I would be more inclined to stay away from the crosses at the moment, especially as the uncertainty of all the developments in the global economy are developing. Or if I was going to go into them, I would do it on a smaller amount, because it's going to be choppy, and you're going to have big, huge ranges on days where it's really moving, and it could chop you up quite easily. So in times of uncertainty, in times where liquidity is less, it's always best to scale back your trades and be more risk averse rather than taking on in the risk, especially in these risky currency pairs.
Okay, Greg. Well, we have to wrap it up for today, so thank you very much for joining me, and thank you very much for your strategies and recommendations.
My pleasure, Remy, and have a great day.
Thank you. This has been your New York Forex Market Buzz with Greg Michalowski from FXDD. I'm Remy Hokie. Join me later this afternoon, 4 p.m. exchange, right here on ForexTV.com.